I think the downside at these levels is minimal and the upside is really big. Hey everyone, it's Andrew here. So I've been doing some work on these companies, preliminary work to see if I should dig deeper. Here are my thoughts so far. Maybe you see something you like here as well, and it encourages you to take a look. Also, I'll give you a take on what I like and don't like so far. That might help you decide if it's worth your time. So let's go through the 6 companies that I'm currently investigating. Firstly, a lot of this work is from Hamish and Andrew Latender. Thanks guys for helping me out here. So what I like about this business is, it's a simple business. And Monster Beverage has shown that drink companies can be hugely successful investments. Now, craft beer is actually growing really strong and it has about a $22 billion total addressable market and it is growing. So Boston Beer has a great product line in this great category. I also like how there's strong incentives with the biggest shareholder, and if he's the founder and running the business. When I went over the financials, I like their balance sheet, I like their cash flow statement, I like the growth that they're showing. It looks pretty good from a financials point of view. But the things I don't like about this company is that they're just gonna have to continually innovate to keep growing because it's a really highly competitive space. There's a lot of players in it and it's too expensive for me at the moment based on a valuation point of view. All right, next company is Trulieve, and most of the credit for this one goes to Andrew Latender again, Daniel Pronk, Cameron Stewart, and the channel Unrivaled Investing. Thanks guys for your work. It has helped get a better picture on this one. Now, what I like. Now, Trulieve is now one of the largest cannabis retailers in the US after acquiring Harvest. They sell cannabis products in retail locations. I think the business is pretty simple to understand, which I like. And the industry has a lot of tailwinds. See, more states are legalizing cannabis and that is opening up more and more consumers. The total addressable market is really big, estimated to be 4 times bigger than it by 2030 than it is today, and not many industries are growing at these speeds. I like that Trulieve is profitable, yet it's also growing super fast. And speaking of growing super fast, revenue is flying along at about 100%, but it has slowed a little to about 60% year on year. Oh no. But they are about to add a huge amount to their revenue with that recent acquisition of Harvest. Now, their operating cash flow has been growing in line with revenue, but free cash flow is negative as they are spending a lot on growth. Most of this money is going to growth. And I'm okay with this because I see the operating cash flow grow and that gives me confidence that the cash is actually coming into the business. Regarding debt, well, it's fine. Insider ownership is strong and I like the focus on profitability from this strong foundation they have. I think there's lots of upside here with a very attractive price. I'm going to do a full valuation on this at some stage soon. But what I don't like, well, cannabis, well, it is a bit political and it's still federally illegal, which makes borrowing money super hard and they have to pay ridiculous borrowing rates if they're going to use it to grow. And it also means that the tax rates are like insanely high. I think the effective tax rate for the last 12 months is like 70% or something insane like that. And I just don't really get marijuana culture. I don't use it. I don't understand why it's so popular. I guess maybe I should go on some research trip and get some first-hand experience. Anyway, the CEO's husband has been found guilty on corruption charges in the past, and that's a very ugly look. So this isn't far from a perfect investment. But the risk reward, based on the price, looks really asymmetrical. I think the downside at these levels is minimal and the upside is really big. And that's my take on it so far. Still some more work to do. The management integrity is going to be my focus. Now, if you want to see all the companies that I follow on my watch list with up-to-month buy prices, fair valuations, and what I think the price appreciation potential could be, well, sign up to my e-magazine called Undervalued. I release a new version on the first Wednesday of each month. It's only $10 a month, and I hope it provides far more value than that for you. And you can check out the February edition for free if you want to see what it looks like and what you can expect and stuff like that. Anyway, link in description. So Carvana is an online used car buying and selling one-stop shop. This is completely because of Robert Vinal doing a fantastic write-up about this company, and he has invested. I would consider Rob a super investor, and I think he is a very smart guy with a fantastic track record. He has a better understanding of fast-growing companies than me, and Carvana is fast-growing. Here are the things that get me interested. Revenue has been running at over 100% per annum Every year for the past 5 years, they're improving the used car buying experience. This is really important. The experience for shopping online, buying in these car vending machines, the full vertical integration of the whole process, it's just a better way to buy and sell used cars. I like Ernie Garcia, who's the founder and CEO, and he has a true passion for the business and a big stake in it himself. I like the scale that they're starting to reach. I like the brand recognition, and that will help be a strong competitive advantage in the future. I think buying online is only getting more popular, not less. And in this industry, it's a bit of a winner take most space. Similar to marketplace businesses like real estate websites, the market concentrates on one or two players eventually. Carvana is already the best in the space, and they only have 1% market share, so the runway is very long. And I respect Rob Vinal, and I think he knows what he is doing. But what I don't like, well, used cars, I guess, are still going to be a thing, but I was hoping driverless cars would dominate the roads in the next 5 to 10 years. I guess we all still have cars, but maybe that total addressable market will shrink. That's what I think. I also don't like how they've been diluting shareholders. It's all about size and scale, I get it, so raising money is just part of that equation. I just don't like it because I am worried that it is all about the execution now, and my margin of safety is getting weaker with the dilution. They also have a lot of debt. It's obviously fueling the growth, but a lot of debt makes me uncomfortable. It's also quite hard to value as operating cash has always been negative. I can value it based on, say, future revenue and estimated profitability, but I think it's all about execution in this case. And I'm not sold on the future of the used car industry. And this one is courtesy of Hamish Hodder again. I was going through his course, which I highly recommend, and there is a link in my description for those wanting this amazing resource. And I found Thor Industries, which at first glance, I really liked. Thor is a caravan motorhome company, essentially. They make these and sell them to resellers. It's nice and simple. And here is what I have found. Firstly, it's actually a cyclical business, and the boom is probably right now or at the end of the boom time. So that is going to make valuations a little tricky. But I do like how they have these long backlog of orders. So that's helpful regarding future projections of revenue, and about 50% market share, which makes them the dominant player in the space. The market is growing at about 6%, which is fine, not groundbreaking. They do have a lot of debt, which I think is serviceable, but still a lot of debt. The CEO does have a big compensation package compared to his shares, which I don't really like. The founder, Peter Orthwan, still has a big stake in the company and is still the main person on the board, so that's good. It makes a lot of quality free cash flow, and I like that a lot. But I don't like how raw material costs are going to obviously get substantially higher in the future, and that's going to eat away at their margins. Well, they're going to have to price that in and put that on their dealers. I'm also a bit worried that the growth might have already happened and we are in for a few flat years. I don't really know. Maybe I can get a depressed price in the coming years based on people getting bored of this and looking for better alternatives. I still have plenty of work to do on this one, but at first glance, I do like it. So this one had me confused for a while. I have looked over the financials time and time again. And I think Monish Prabrai sheds some light on it here.
The largest position I have right now, I don't talk much about my current portfolio, but the largest position we have is Micron Technology. It's in the memory business. And for the longest time, the memory business for decades was a terrible business. Boom and bust, too many players, someone innovates, cuts their cost in half. Now all your inventory is, the price of your inventory is above the selling price, and you're losing money while they're making money hands over fist till you catch up. And maybe you can catch up or maybe you don't. And it was all of that going on, Moore's law, and prices declining, till we hit a point where we were left with three players. And we got left with, I think, three rational players. And the game changed. Now, everyone saw that there were three players, but they had so much history and pain from the decades in the memory business that they refused to believe that anything was going to be different. And my thesis about 3-4 years ago was, it's completely different. And so the thing is that if you look at a Amazon data center, and if it costs them, 200 million or 100 million to put that up, About 30% of that is going to the memory guys.
Wow.
So it's a tax on all the streaming, all the e-commerce, all the shopping, on everything. 30% tax. I'm sitting collecting the tax.
Now, I'm going to try to find out whether this thesis from Monish is still true, and maybe I can figure it out for myself. But here are the other super investors that have large stakes in Micron. We've got Guy Spear, Lee Lu, David Tepper, the Sequoia Fund involved, Seth Klarman, Prem Watsa. This is an exceptional list of very smart people. They have all figured it out, so I'm gonna have to work on figuring this one out as well. Now, if you are just starting out with investing, well, I use Interactive Brokers as my platform as the fees are really low and I can access international stocks. Yes, I know there are free commission brokers out there, but I don't think they are super safe as they haven't been around for very long. Plus, they just don't give you access to international markets. So use the link in my description to check out a demo account to see if you like how the platform works. And I have some demonstration videos here on the channel too. So another Monish Pabrai investment here that I'm interested in. I also know there has been a lot of great work and analysis from Investing with Tom, Matthew Peterson, and Brad Kellner over at the Stock Compounder, all here on YouTube anyway, you can find their channels. No need for me to rehash this already great work. But if you are new to this one, essentially the company has these old Sears properties and a redevelopment plan to turn these properties into these multifamily and mixed use spaces. The idea is to significantly increase the value of these blocks of land. Now, conservatively, the business assets, just the land and the buildings that they already have, are worth around $25 to $30 a share, even including the debt that they've borrowed from Berkshire Hathaway. But there is a lot going on here. With a potential takeover offer, there's potential refinancing and ongoing execution costs starting to rise. Well, when I'm preparing this video, the stock price is like $11 or something, which is a big gap between the stock price and that net asset value that I said is somewhere around that $25, $30 mark. We've got Guy Spear and Monish Pabrai, I think, still invested in this one. We've got Berkshire Hathaway, who controls the debt, and Eddie Lampert is the biggest owner at 22%. So there are, again, some very smart people involved here. And for me, the main issue is that if it goes private, well, it's not going to be this long-term compounder that I'm looking for. But I do like making money, and this feels simple enough to understand, and I'm pretty confident it's undervalued. Now, before I go, I want to say a quick thanks to Investing with Tom, Andrew Latender, Brad Kellner, Hamish Hodder, Matthew Peterson, and all the others that have helped out. I appreciate you all for sharing your work. It saves us all a lot of time and gives us a great base to go off and look at things ourselves. Please keep it up. That's what I'm trying to do here in today's video, and I hope you got some value out of it. You are all legends. Thanks for staying to the end, and I'll see you in the next video.